In this video, we're going to be going over 5 dividend stocks that I believe deserve a position in every dividend investor's portfolio. We're going to be going in these 5 dividend stocks in a rate from lowest yield to highest yield. Some of these have a yield of lower than 1%, which are technically qualified as dividend growth stocks. And then we also have some with upwards of 4%. So these are dividend higher yielding stocks. I'm sure you have an idea of what these 5 stocks will be. They are all in my portfolio. If you want to get access to my portfolio, which you can see right now, what we're looking at is all the different slices in my portfolio. You can get access for 100% free. The link will be in the description or in the comments below. You can find it in both. It'll say dividend portfolio. You can just check that link. It'll take you to M1 Finance. And make sure to check out M1 Finance if you haven't already. Sign up with an account using the link in the description or comments below, because M1 Finance is doing a brand new promotion to where if you sign up and deposit $100, you and me both will be getting $50 of free money to invest, or you can take that money out, put it in your bank account, and do whatever you'd like to. But enough of that talk and enough of the intro. Let's get into this video. So what we're looking at right now is my favorite 5 stocks at the moment, and that is, first up, we're looking at ticker symbol AAPL, Apple Inc. You know who Apple is. The biggest company on the market right now with a market cap of $2.63 trillion over this past year is up 35.33%. They right now have a PE of 28.21. That is their forward PE ratio, which is a little bit higher, but it differs industry to industry, especially with tech stocks, because tech stocks are a little bit more overvalued, I guess you could say, just because of the simple fact that their earnings, the amount they make, price to earnings, differs from a company like a financial stock, which we will be looking at one financial stock later within this video. But the dividend yield on Apple right now is 0.55%. And what we're going to see is that they have some pretty solid grades for their dividend. Dividend safety is a B+, dividend growth is an A+, the dividend yield is a D+, and that is just because it's pretty low, 0.55%. You don't necessarily, if you're looking to get dividend income automatically and instantly, betting on Apple and investing in Apple is probably not your best bet. You would have a better chance of investing in maybe the last 2 stocks we're going to be looking at in this video, so make sure you stay tuned for those. They have a payout ratio of 15.46%, which is very low, a 5-year growth rate of 9.1%, and a dividend growth streak of 9 years. Now, looking at Apple's income, you can just see this thing is increasing year over year. Ever since 2019, massive increases. Now, look at that net income, $94.68 billion in net income over the trailing 12 months, which is incredible, incredible stuff. Looking at Apple's difference, just look at this. Look at these net income jumps over the annual look. 2020, $5.741 billion in net income, to 2021, $94.68 billion. That's a very, very big jump. Look at their EBITDA, $81.02 billion in 2020 compared to $123.14 billion in 2021. These growth records are incredible. You can see their earnings per share is not slowly, but definitely just increasing at incredible, incredible rates. So why might that be? Well, what we can see is that they're making incredible money. And why is earnings per share important? Because however much money this company makes per share is how much they can pay to their shareholders in dividends per share. So you want your earnings per share to increase, and what we're seeing is Apple's is very easily doing this. And with that being said, it leaves them more opportunity and more money to pay out their shareholders, which is you and me. Free cash flow increasing incredible amounts. Their debt is increasing slowly, but it's not like it's increasing at a concerning rate, so this is okay. Cash all over the place, companies, different things like that. But let's talk about the second stock on this list, which is Apple's friend, Microsoft, ticker MSFT. They have a dividend yield of 0.72% and a PE of 37.43 on the forward. Now, that is a little bit more overvalued than Apple, but what we're seeing recently with Microsoft is some huge gains. Over the past year, they're up 61.52%. Over the past month, they're up 11.32%. And just the past 6 months alone, up 41%, which is incredible stuff. And that is my belief on dividend growth investing. Currently, so I'm a younger individual. I have dividend growth stocks, and most of my portfolio is consisted of dividend growth stocks. Now, it depends on everybody's age. Some people invest in high yield, low growth, but I'm aiming for higher growth, lower yield at the current moment. Now, don't get me wrong. I do have some dividend stocks that have some higher yields, like XYLD, QYLD, MO, some different stocks like that. But what I'm mainly focusing on is dividend growth investing. And this is just kind of showing the power of that. If I invested in Microsoft 6 months ago, which I had been invested in them, just say hypothetically, up 41%, well, your yield on cost is already going to be up by a ton, okay? Because your yield on cost is what makes you filthy rich in dividend investing. Warren Buffett is doubling his dividends every 2 years, is doubling his total investment just every 2 years on Coca-Cola because he has a 50% yield on cost, which is insane stuff. And that's how you make real money within dividend investing and get insane cash flow for your portfolio. Microsoft has incredible dividend grades, A plus on their dividend growth and an A on their dividend safety. Looking at their payout ratio, it's 27.06%, a 5-year growth rate of 9.37%, and dividend growth record of 17 years. Now, I'm not going to, we can see right here, Microsoft, they have a fair value of $345, and a last close was $343, so they are trading on a slight discount but near fair value. They have a lot of upside potential with this company. They have a wide moat that they believe is stable. Looking onto some more things, a nice profit margin of 39% and an operating margin of 42%. Look at the growth records that we're seeing. Quarterly earnings year over year and quarterly revenue year over year. Incredible, incredible growth. They have a market cap of $2.58 trillion. And you can just see, look at all the uptrend momentum on free cash flow, net income, debt is downtrending, EBITDA, revenue, cash, their dividend, their earnings per share, their shares outstanding is decreasing, which what does that mean? It means that every share that you buy, you're getting more ownership within that company. So that is a very, very good thing to see. Sometimes it varies company to company on shares outstanding, share buybacks, but we're not talking about that in this video. What we're seeing right now is Microsoft is undervalued by 0.64% compared to this discounted cash flow model, valuing Microsoft at $345.34. It says that Microsoft is trading below their intrinsic value of $352.39 and their good value based on their earnings relative to the share price compared to the U.S. market average. Microsoft is 38.04 times and U.S. market average is 41.52 times. Now, let's talk about the third stock on this list, which is the Home Depot, ticker HD. This stock has been going up incredibly over the past few weeks. We can see they have a PE right now of 26.41 and a dividend yield of 1.61%. This is one of my favorite dividend growth stocks. Over the past 6 months alone, this stock is up 29.97%, and over the past month, they are up 14.16%. Dividend grades, incredible. A plus on both the dividend safety and the dividend growth, a C minus on dividend yield just because it's not super high. They have a payout ratio of 42.65%, which is very solid and very sustainable. They have a 5-year growth rate of 19.38%, incredible growth rate on this dividend, and a dividend growth record of 12 years in a row. Looking onto some different things, uptrending net income, uptrending free cash flow, except for recently, free cash flow has been dropping a little bit, but that's okay. Revenue, up incredible. EBITDA up incredible. You can just see shares outstanding are decreasing, dividend increasing, earnings per share increasing, and those are the big important factors. Now this is saying Home Depot is trading below their intrinsic value of $423.16. Their good value based to their PE ratio of 28.64 compared to the market average of 41.52, and their PE ratio compared to their industry average of 82.24, which is very, very solid. However, what we will see is that Home Depot is on Morningstar very, very far below their fair value of $244, which is why I currently, and I'm kind of doing this on all my stocks, is I'm playing a bit more conservative at the moment. Now, I know that they say don't try and time the market. Timing in the market is what matters most. And don't get me wrong, I completely agree with that. I believe if you're just sitting with cash waiting for the market to crash by 50% in a single day, you're screwing yourself. So I think it's important to have a lot of money, as much money as you can in the market, but it's also important to have cash set aside in the event of a downturn because everything is kind of pointing towards it. Like the market is highly overvalued right now. And especially with some of my stocks like this, like Home Depot trading at such a premium, I don't know if it's worth it for me to buy right now. I'd rather get in a better price when I believe that the stock could fall. So what we'll see right though is that Home Depot, thinking on a long-term outlook, is incredible potential. Home Depot should continue to capture top-line growth beyond 2021, bolstered by aging housing stock and rising home prices. Different thing with COVID-19 demands, expansion of newer, like textiles from the company store acquisition, as well as existing, such as appliances categories, could also drive demand. Huge growth with different catalysts, efficient supply chain, improved merchandising technology, and penetration of adjacent customer product segments. Huge upside potential for this company, especially in the long term. Now let's talk about the fourth stock on this list, which is kind of not necessarily talked about that much, which is ticker TD, the Toronto Dominion Bank, my favorite stock in the financial sector of all of them. And they currently have a dividend yield of 3.45%. Over this past year, they're up 38.37%. They have an earnings per share of $6.14 per share and a PE of 11.83, which is very, very solid and very low. A market cap of $132.14 billion, and their dividend grades might not be the best, B plus, C, and a C. They have a payout ratio of 40.87%, which I believe is very sustainable, a dividend growth record of 7 years, and a growth rate of 9.11% on that dividend over the past 5 years. Looking at this, TD Bank Group ranked among most sustainable companies according to the Dow Jones Sustainability World Index. TD is the top ranked North American based in the world index. Top ranked a North American bank. That's incredible. That's huge. This company has so much upside potential, and I love this way this company is growing, the different things that they're doing, and just the whole overall company. You can see this is TD Bank. TD Ameritrade is another sector of the company. It's mixed with Charles Schwab. There's a bunch of things that go into play, but look at the growth that they're seeing. They have 59% quarterly earnings growth and year-over-year 27% quarterly revenue growth. Insane profit margins. Look at this. Uptrending revenue, uptrending EBITDA, uptrending net income, uptrending dividend, uptrending earnings per share, uptrending cash. Incredible things that we're seeing on this company. Now let's talk about the fourth and final stock on this list, which is Realty Income, ticker symbol O, the monthly dividend stock that everybody loves, up 16% just this past year with a dividend yield of 4.16%. A market cap of $40.15 billion. They have some pretty solid dividend grades. A C on their dividend safety, a B plus on their dividend growth, a B minus on their dividend yield. Now, they have a payout ratio of 85.46%, and you might be looking at this and being like, whoa, isn't that a little bit high? Well, technically, REITs are required to pay 90% of all their taxable income back to shareholders. Taxable profits, all their profits, 90% of them that are taxable back to shareholders. Sorry about the little stutter right there. They have a dividend growth record. It says 24 years on Seeking Alpha, but I believe it's actually 26 years and a 5-year growth rate of 3.46%. What we're looking at right here is that they're trading below their fair value by 9 cents. They had a great rent collection for the entire company improve to 99.6% from 95.9% because of movie theaters coming back. And they have same-store net operating income was up 6% in the quarter, driven by a 7.1% improvement among retail tenants. Big things. Looking on some more stuff, look at their quarterly earnings growth and their quarterly revenue. Now, this is kind of offset by COVID and a bunch of different things, but huge profit margins, nice different things, uptrending net income, revenue, uptrending EBITDA, uptrending earnings per share, uptrending. So many different things are looking very solid for the stock. Now, this says that Realty Income is trading below its intrinsic value of $200.58, which I'm not saying that Realty Income will never hit that price, but it's trading very, very low compared to that, which is showing there is still value and potential within the stock. Now, they have different price to earnings ratio compared to the market average, but that's okay. There's been going through some acquisitions, so different things, causing their operations to go up a little bit higher. But everybody, that's what I have for you within this video. So if you did enjoy it, make sure you give the video a thumbs up and you subscribe. You turn on those post notifications for videos coming out every other day. Make sure you leave a comment below just what you think about these stocks, which is your favorite, or if you have any other stocks or ETFs that you recommend. Remember, everything said on this channel is not financial advice. Thank you for making it all the way to the end of the video. Check out M1 Finance to get some free money. Use the link in the description below. But again, thank you, and I will see you at the next video.